Welcome to Retirement Protection Solutions Financial Planning Masterclass Mini-Series. Today's video is going to be short, and we're going to focus on how to collect indexed returns with no market-linked risk of loss. No risk of loss as guaranteed by an insurance company. So we're going to explore that today and how it might be appropriate for part of your retirement plan. The disclosure, please pause your video and read through the disclosure if you wish. Okay, I am Larry Spoth, President and Founder of Retirement Protection Solutions. I am an investment advisor representative, and we're bound by all fiduciary and best interest laws and rules. Jacob Child, Managing Partner at Retirement Protection Solutions, investment advisor representative, and also bound by all fiduciary standards and best interest rules. Okay. We are local to the district, Maryland and Virginia. Our home office is in Tyson's Corner, which is where I am today. We focus as a firm on full service retirement planning. That is, building full legitimate retirement plans for people, net of tax tables, inflation projections, required minimum distributions when you hit 73. We plug in all your different income sources like Social Security. If you're married, your spouse's Social Security, maybe you're government or military and you have a pension. All of these data points go into the retirement plan. And what we do is drive to your after-tax retirement income goal. So we want to get you to your after-tax goal with the least amount of risk possible. Today, we're going to look at one piece of a potential part of your retirement plan, which is the indexed retirement accounts. They have no risk of loss guaranteed by an insurance company. I kind of coined the phrase, I like to call it a bond replacement program, because some people want to take some risk off the table. They want no market-linked risk of loss. And instead of using bonds, maybe we use these products instead. Let's take a look. During the masterclass series, we already explored structured notes and how to mitigate risk. We already explored high dividend yield portfolios to help generate income for you in retirement without ever selling any shares of your stock. Don't touch the principal, just take the dividends. And we use this algorithmic approach, and we do the same thing for the growth stock portfolio. But with that said, today we're focused on safety, how to get indexed returns with no risk of loss. Okay, let's think about this for a minute. This is the S&P 500. It's just a look back period. And we're going to look at this red box down here, and we're going to look at this period from about 2000 to roughly 2012 or 2013. And what we see in this time period are two recessions. So we got to think about this. You and I don't know what the market's going to do next week, much less 2 years from now or 5 or 10 years from now. We don't know. So we're going to look at this historical time period, which, history doesn't repeat, but we want to learn from the past in order to maybe allocate in the future. So let's hypothetically say you retired right here in the year 2000 when the dot-com recession started and the market moved down. Now, if you're pulling money from your portfolio and you're losing money at the same time, it's a double-edged sword. You're accelerating your losses. And even when the market tries to recover, and it did, but if you're pulling money out for income as the market's trying to recover, you're holding back the returns you're getting because you're pulling money out, and you probably would not have returned back to that point. And then the market did it again in 2008. And of course, if you were pulling money during this time period, you were probably in a very, maybe a catastrophic spend down type environment. Everybody's different, but maybe that was the outcome for these people. So we want to avoid that. What we want to learn how to do is put some of our money on what I call the green line. The green line is how we can be indexed to the market with no market-linked risk of loss, but we can still have the potential to earn money. Let's see how that works. This is a hypothetical example. Let's say this was you, and you rolled over $200,000 from your 401k or your TSP, whatever you have, or maybe a 403b. So this would become an IRA. So there's no tax or penalty to roll it over. There's a rule at age 59 and a half, so we would explore that individually. But let's say you rolled this over. And the gray here is the underlying index that we're allocated to. So if that index is moving up, we're collecting those returns every 1 year. Some products are every 2 years. Some products are every 3 years that you lock in your returns. But either way, in this example, every 1 year, whatever you earned based on that index is locked in. Locked in is the key phrase, because let's think about it. If your money, again, hypothetical growth here, let's say you grew from 200 to 250,000 and it locked in on the anniversary of your policy, and then the market or the underlying index went down. Well, your original principal and all the earnings you collected along the way, locking them in, are now protected. You cannot lose them. You can't lose any money in this product as guaranteed by the insurance company. So the way we start making money is, since we didn't have any losses, when the underlying index starts to move up again, we're collecting returns and locking them in. They're added to your account every 1 year or 2 years or 3 years, depending on which product you choose. And we lock them in so that at some point in the future, let's say your account grew to 650 and the market's way up, and then it tanked, it went way back down, maybe a recession, a market correction, let's hope not a pandemic, but the market went down, all of your principal and all of your earnings that were locked in along the way are protected from losses. Now, when you're utilizing these types of products, you need to work with a financial professional that has to work under that fiduciary umbrella, because some of these products are complicated and we don't want to get into one that looks good, but maybe has caps on your earnings, right? We want to try to pick the index and the strategy to the best of our knowledge that is going to give us the best returns and still lock in our returns. Okay, so be careful and rely on a fiduciary standard to help select your products. Now, let's take a look at a real world index. In this example, we have the black line, which is the Morningstar Wide Moat Index. One of our companies offers us that choice. And in this chart, I also have the orange line, which is the Vanguard Bond Fund. And we can see what both of them did from about 2017 all the way through about 2023. And I just did this screenshot from Bloomberg. So let's say this black line, let's hypothetically say this is you, and you allocated money to this account, and the index went up, had some volatility, and let's say this is your anniversary, so these products would lock in automatically those gains. Then there was some volatility. Now with this down volatility, remember, you can't lose any money. You'd be flat at this point, but then it came up. And if this were your anniversary again, it locked in. And if this were your anniversary again, it locked in. And if this was the anniversary of your policy, it locked in again. So now your money is on what I call the green line. And what happened in 2021, the market started to correct down. We entered into a bear market. So the markets dropped, but this account, your money would have been protected from any losses. Well, what about going forward? Let's again, hypothetically say this is your anniversary, right where the dotted line is. So on your anniversary, it's kind of like you bought back into the market at a low point, and assuming it went up again, whatever you earned from here to here is added into your account, and it keeps ratcheting up like we see in this screen here, assuming you have gains. So we wanted some of our money to be safe. Now, a lot of people, and we can use bond portfolios as well, but a lot of people thought that bonds were their best hedge for safety. Okay, so let's take a look at the Vanguard Total Bond Fund, which is a great fund, but here, if you owned bonds, you can see the value of your bond portfolio is going down, and then it went back up a little bit, the value of the portfolio. And right around here is when the Feds started increasing rates, right? Remember, they were raising rates to try to knock down inflation. Well, the value of the Vanguard Total Bond Fund really tanked, similar to what the market did, which really is one of those rare instances where the stock market was going down and so were bond portfolios. And this is where people sometimes really got hurt because they thought bonds were safe. Not necessarily. So let me ask you this question. If you, back at this point here, said that you wanted a certain amount of your money safe, would you rather be here at this point in time? Or would you rather have your money be up here, indexed and protected? Still potential growth. Bond values can recover too. But why go down if you don't need to? That's my point. And this is why I nicknamed this type of product a bond replacement program. I just like it better. Now, with that said, everything has its pluses and its minuses. So should we engage in retirement planning, I will give you the good, the bad, and the ugly of everything. I don't care. We're going to unwrap it and teach you what we like and maybe what we don't like so much. Same thing with bonds, same thing with these index products, same thing with the structured notes that maybe you've seen that video, same thing with the dividend portfolio or the growth portfolio. Okay, we want to unwrap everything and teach you how they work in the retirement planning process. So this type of product, we're just ratcheting up our returns, totally protected from market risk. Here's what it looks like. And now we're going to come to our create your retirement plan screen here. So if we take an appointment with you, the first thing we're going to do is we're going to give you a total analysis of your current plan and investments. We will provide a complimentary Morningstar analysis based on your current investments. You've heard me say it before, maybe, if you've been watching these videos, but Morningstar is a giant financial company that's known for its analytics. So we send your statement up to Morningstar, and Morningstar sends us back the data, or in other words, what is going on inside your portfolio. Let's say you're stacked up in mutual funds. What are the internal costs of mutual funds? Many people don't know about 12b-1 fees, etc. So it adds to your cost. So Morningstar will tell us all the different variables going on in your portfolio, and it's important for you to have that data so you can find if there are any weaknesses in where you're structured now. Step two, we need to understand your goals and objectives in order to be able to advise you or build a retirement plan. We have to know what your after-tax income goal is for retirement. We have to know your risk profile. All these different things are required. Your plan will include inflation projections, tax tables, required minimum distributions, and once we have that plan built, we're going to test it in random market events. Some years with losses, we're going to run that simulation for you because we want to make sure, to the best of our ability, your retirement plan is secure and has the best chance for growth. Step three, once that plan is built out, we've gone through it with you, we're going to come back with you again, and we're going to drill down into that plan and unwrap everything and make sure it's exactly the way you want it. Now, we're going to advise a particular way to structure it, but you might say, well, you know, Larry, I like that safety index thing that you just showed me, but I don't really think it's appropriate for me. Take it out. So we'll take that out and we'll rework that ball of wax until we get it to the way you like it, and then we'll test it again. Okay? The planning process that I'm talking about is complimentary for our webinar viewers with investable assets over 500,000. And the reason we do that primarily is because these different products that we're teaching you about on these webinar series, we need to have a certain amount of money in each to be able to allocate. And we need to have enough money to potentially reach your income goals and keep that portfolio potentially growing. So based on that, if somebody is under 500,000 and we need to break that rule, we will, as long as it makes sense. We want to be able to make sure we're fulfilling our fiduciary standards. So sometimes if you're less than 500, sure, we can work together. Other times 500 is the general rule. I hope you liked this video, and I hope that gave you a little bit of insight as it may or may not be part of your overall retirement plan. Thank you for watching. Have a great week and have an even better retirement.